Welcome to the Sunday Night Death Burger program for the week ending 9/10/2010. This is John Galt speaking. A reminder, the information presented is not for financial investing purposes. It is for your historical reference and use only. If you do wish to use any information, please seek a certified financial professional. And with that being said, it was a very interesting week. We're going to do all charts, and more charts as the burgers come onto the screen and indicate the beginning of the series of charts. The first chart is a one-year daily chart for the Dow Jones Industrial Average. We're at a short-term top according to some indicators. I tend to agree with it. The death cross is still intact. Short-term support is a couple of 100 points down. I don't think that's going to hold. I think it's going to sit there and crack up and eventually fall down. Moving on to the next chart, something that's been talked about by some people, you see the clear head and shoulders. Left shoulder, top head, and right shoulder with the three curved lines on the chart. It's probably going to happen that way, and that's sort of scary. The one-year weekly chart is most interesting. You can see the neckline drawn through there and the downtrend that's been established on the right-hand side of the chart. I don't think that the Dow is going to hold much longer. We have a very nasty technical formation for this particular chart. You'll see it on the weekly chart also when you look at the Head and Shoulders presentation. I don't give it as much credence as I do the death cross, but it is more supporting evidence of a potentially deteriorating technical condition for the market with low volume and very, very little commitment by the traders, retail or commercial, to move forward. The 3-year chart shows the longer-term downtrend firmly still entrenched, and we seem to have started the new process again of lower highs and lower lows. With those lower lows, you can expect a breakdown and further testing of even longer-term lower marks below what we've saw earlier this year. The S&P 500 is the same way. As you can see from the chart, the downtrend is firmly established. It does not look like it's going to break down. This is a one-year daily chart of the S&P 500. Sadly, I don't think we're going to see a happy ending there either. The death cross is still wide open on it. You can see it marked there on the graph. The did not get to some of the support level, the former high levels. It needed to get back towards 1120. It didn't happen. It needed to get up to 1130 to really show and indicate a new rally. We're having failings at prior lows, and we didn't get to the 200-day moving average. On the S&P weekly chart, you can see it, the one-year chart on the weekly close, the same head and shoulders pattern you saw on the Dow. This is a very negative correlation. It's a much broader index. If this is truly indicative of what we're about to see happen, I tend to agree with the people who think that we're going to see a substantial market correction in the near future. And if you look at the next chart, show where I sit there and I look at the resistance points, you see that the 1150 is the number 3 point. It's the ultimate resistance. The number 2 was the 1130-ish. We didn't even come close to that. And the first line, number 1, is 1120. We didn't even make it that, with very little volume, no retail participation, and mommy and daddy trader out in the Hamptons or the Caribbean enjoying a vacation before they had to come back to work next week. Well, they're coming back to work tomorrow, and I don't think they're going to change the downtrend you see in the 3-year chart. This is the weekly 3-year chart. The downtrend, once again, is firmly established. This could be one more day of up prices, or it could sit there and start rolling over tomorrow afternoon. No one knows, but one thing we can tell, the downtrend is still firmly established, and a lot of that has to do with the financial sector. Here's the regional bank index, the KBX, the Philadelphia Regional Bank Index, and as you can see, you have the same head and shoulders pattern. You have a death cross right there in the middle of the screen on the right hand side. It is not, I repeat, not indicative that of a rising index. It looks like it's going to break down even further, and we're going to take a look at some of the other banks that make up the index to get some idea as to how bad this deterioration could get. Let's start with J.P. Morgan. J.P. Morgan has been in a long-term downtrend. You have a death cross. The 200-day moving average has been sloping down, and now we're coming up to the 4170 resistance area, and we didn't even come close to that in this recent rally. Now, this is the strongest of the strong when it comes to these charts, but it didn't quite make it. In my opinion, this is an indication, along with some of the other large banking companies, that we're not going to see a typical financial crash or recovery more so than we are going to see a crash in the financials, which will lead the rest of the market down further. Goldman Sachs, same thing. I put a question mark. Is there a head and shoulder pattern forming? We didn't quite get to the upper high, but if we start to break down here, you have to ask yourself, this is a 6-month daily chart. If it does sit there and roll over at this point in time and fail, which it appears to be in the process of doing, then we will probably go back down into the 130 level and give that a nice, firm, hard test. As I've been trying to tell people, Goldman Sachs is the key. Watch it daily. Bank of America is in horrible shape. The death cross, the downtrend, everything is pretty well established. We barely made it back up to the 50-day moving average. Both are declining the 50 and 200-day moving average. There's numerous concerns about their takeovers of Countrywide and that portfolio of the Merrill Lynch portfolio, what it's really worth. Can they liquidate some of it as BB&T has begun liquidating? It is not a good sign when you see one of the largest banks in the U.S. breaking down this severely. PNC, another regional. I've put on the charts the phrases and points of lower lows and lower highs and the death cross which just occurred. Again, another large regional bank showing signs of a technical breakdown, rolling over into the worst month of the year for trading. If it continues this trend, it could be one of the leaders to the downside, much like Bank of America, Goldman Sachs, and J.P. Morgan were warnings beforehand. Now we're going to see the regionals. Regions Financial just had its death cross. It hasn't had a series of lower lows yet, but it has been declining and moving in a downtrend, as you can see from the arrow. If this downtrend persists and we see a widening between the 250-day moving averages as they start to roll over and decline, it's a fairly safe bet that we're going to see this stock continue down further. And it's only a $7 stock, and it didn't recover much during this recent rally. Northern Trust, one of the stronger banks, is indicating even worse technical situation. As you can see, the death cross occurred back in June, and you see the breakdown, June-July period. Since that time, it has really broken down severely, barely holding on to the 50-day moving average in this recent, shall we call it, Labor Day rally period. That is not indicative, again, of a stock or portion of the economy recovering in any great degree. Zions Bancorp has not had the death cross yet. But there is one imminent. That's a 6-month daily chart, just to give you a little better, but it is illustrating a series of lower highs and lower lows, and does appear to be on the verge of rolling over. Another bank with declining loan portfolios. In other words, they're not making as many loans, so they don't have as much business to generate. And you're going to see this as a trend with all of the regionals. The new KeyCorp Financial, same principle. There's no way it's going to recover towards its prior highs. As you can see by the severity of the decline, the 50-day moving average has rolled over. It had a golden cross earlier in the year and now appears to be on the verge on this 1-year chart of having a death cross probably within the next 2 trading weeks. Not a good sign, and our regional banks are in horrible shape when you start breaking it down to this level. So watch those indicators. The dollar is also showing signs of breaking down. This is the UUP, or the bullish fund. It's a 6-month indicator. There's a death cross imminent in that particular fund. Also, what worries me about this is that it was such a rapid descent in the last 60 days. You have to wonder what is the underlying cause of that, even though we're being told that the dollar's maintaining relative strength strong to other currencies like the yen, like because it's starting to recover there slightly. But against some of the other currencies like the sterling and the euro, they seem to have thought this was a stabilized matter, but the franc and the Canadian dollar are telling you another story, as well as the Aussie dollar. When you flip it over and look at the UDN, which is the bearish fund of the same genre, the dollar bearish fund looks equally as poor. It is sitting here well below its 200-day moving average, but there's an flip it over. There's a potential golden cross, or the 50-day crossing back over. As you can see, the 200-day has been diving for such a long period of time, it doesn't even show up on the chart. The 50-day moving average appears to have bottomed and is starting to rally. People are beginning to believe that a dollar breakdown is imminent, and that the problems that are going to be created by the Basel III Accords ratified today and potential FASB re-regulation of forcing mark-to-market are going to cause further issues for the dollar and the banking system. That's what I'm trying to point out. You're hearing all of the happy, joy talk, but the financial system is under intense duress and stress, and it's best illustrated when you look at these charts, short and long term, and begin to understand we're not even close to recovering to levels that we saw back in 2007. I'm going to bring something new in here, the put-call ratio for the Philadelphia index. And we're back at another extreme on this. It was at a 0.20. What I'm wondering about, this is a weekly chart, 1 year, which bounces up pretty dramatically. And you can see from the first circle, we're down to 0.19 on a put-call ratio. Now, this is a pretty heavily traded options arena. What concerns me is that we're starting to get back to levels that were extreme again, and it does appear that no one is really buying insurance for a decline. It could indicate a new change in market sentiment. If you see the red line, that's generally the norm, and we're far below that, which means more people have been buying call options instead of put options. Shouldn't be that low. It should be closer to the median, even for the Philadelphia, which is a different animal entirely. But you shouldn't see this drastic a liquidation of the VIX options, the VIX, or this one, the XPC, and this is a 1 year. Now the 3 year shows it even better. You see the circles that I've put on there. That shows the extremes, and we're at the next second to lowest extreme that we've seen in the last 3 years. Usually, when you see extremes like this, a major market move is imminent. Not 100% guaranteed. There's no promise we're going to see a 500 point or 20% decline, but it's another indicator for sentiment to tell you the same thing. The CBOE options are also telling you something else. The puts are moving higher on the CBOE. People are starting to, and if you look at this chart, you see the three extremes that I've circled in the 1 year daily chart. Well, we move back up to 0.71 on this chart from stockcharts.com. And it looks like it's getting ready to move right into the stratosphere where more people are going to buy puts for insurance. So remember, don't take the word of everything you're hearing at the mainstream media level or bubble visions. Look for alternative changes. Pay attention to what's going on. Stay nimble. And next week we'll cover the precious metals a little bit more in detail, because there's a little bit of risk moving into the market. I think we might see a nice rally based on the declining dollar. But next week will be the start of probably 4 weeks of massive market turbulence. I honestly believe that we're going to see the kind of gyrations that will shake everyone down to their roots before the election, and then we'll see then we'll see stability entering back into the market with the post-election bounce expected with the Republican victory. For the Voice of Galt, tune in Monday through Friday, 6 to 8 p.m. at www.thewatchmen.fm. This is John Galt speaking. Good night now.